Imagine signing up to pay your mortgage for 50 years. Yes, half a century just to shave a few $100 off your monthly payment. Sounds wild, right? Well, that's exactly what President Trump recently tossed out as a solution to America's housing affordability crisis. Today, we're breaking down why this longer is better loan could turn into a financial trap and why barely anyone is sounding the alarm the way they should. But before we venture into the chaos of the 5-decade mortgage boom, let's take a step back. Because this new idea didn't just pop up overnight. It's the latest spin on an old system we all take for granted, even though it's quietly shaping the fate of millions of Americans, one monthly payment at a time. How did we get here? Let's rewind for a second. You've probably heard of the classic 30-year mortgage, right? It's the bread and butter of home loans, reliable, everywhere, and not exactly a delicacy. But what they don't teach you in school is that the 30-year mortgage is actually a post-World War II invention. Back in the early 20th century, mortgages were much shorter, 5, 10, sometimes 15 years. The U.S. government pushed lenders and builders to embrace a longer timeline to make homeownership accessible for returning soldiers and growing families. It wasn't just a win for buyers. Banks wanted predictable payments. Builders needed buyers. Politicians wanted to deliver on the American dream. The 30-year mortgage took off. By the late 1950s, it was the only game in town. Fast forward to today, and more than 90% of U.S. homebuyers choose the 30-year fixed for its stable monthly payments, long-term predictability, and opportunity to buy more house for less monthly pain. It's familiar, feels safe, and lets banks easily bundle, sell, and regulate loans on Wall Street. But there's a catch with the safe option, and it's hidden deep in the way those payments work. What's really inside your mortgage payment? Every month, you send money to your lender, but do you know where it actually goes? It's not as simple as paying down your house. A mortgage payment has two main ingredients: principal, the actual amount you borrowed; interest, the cost, sometimes massive, of borrowing that money. Here's the bank's best-kept secret. For the first several years, almost everything you pay is interest. That's why home ownership feels like a treadmill set at a 30-degree incline. You're working hard, you're spending real money, but your loan balance barely budges. Why? Because when your loan begins, the largest possible principal is outstanding. Therefore, interest is at its highest. It's not until after years of paying, often a decade or more, that your principal payment starts to meaningfully exceed interest. It's only around year 20 that you open your statement and realize, wow, I'm actually building equity. But most Americans never reach that point. The real problem homebuyers face. Here's something most people overlook. The typical homeowner in America stays put for just 12 years before selling and moving on. That means the clock resets. You never get to the equity-rich years with less interest, more principal. Consider this. On a 30-year, $600,000 loan at today's average rates, by year 12, you've paid over $250,000 in interest. Your loan balance might be down only 10%, barely making a dent. Even if you stick it out for the full 30 years, you'll have paid the bank about $1.2 million, double the price of your house. So you might ask, why not get a 15-year mortgage and save yourself a mountain of interest? Why do most people skip the 15-year option? On paper, a 15-year mortgage is a dream. Lower total interest, faster equity, total freedom in half the time. But the key barrier is monthly payments, and banks qualify you based on income and expenses. Let's look at the numbers for a $500,000 home with 20% down. 30-year at 6% interest, about $2,400 per month. 15-year at 6% interest, about $3,300 per month. That's over $900 a month extra. And since banks use a debt-to-income ratio to qualify borrowers, the shorter loan can require $10,000 a month income, while the 30-year only needs about $7,500. That extra 34% purchasing power means you can buy a $670,000 home on the same budget as a $500,000 home if you only look at monthly payment. So, buyers usually choose the option that lets them buy rather than the one that saves them long term. This is where politicians and developers step in with new solutions. The 50-year mortgage, trending or troubling? Just this week, President Trump proposed the 50-year mortgage as a way to fix affordability. Major developers immediately started considering pilot programs. Given the record-high prices in 2025, median existing home, $410,000, new build, $448,000, millennials and Gen Z buyers perked up. In theory, a longer loan would make homeownership more attainable, right? Here's the reality. Extending from 30 to 50 years looks better on a politician's website than it does on an amortization calculator. In practice, a 50-year mortgage only increases affordability by 8% compared to a 30-year. That means you add 2 decades of debt for the price-cutting equivalent of a pizza coupon. And here's another downside. Longer mortgages almost always come with higher interest rates. The handful of 50-year products available today in 2025 start at about 7% compared to the 6% average for 30-year mortgages. On a $650,000 loan, that means a monthly payment increase of just about $85. But over 5 decades, you're locked into higher rates and higher total interest. Even if rates are somehow equal, the payment drop is negligible, often less than 10%. Stretching your payments is a recipe for disaster. Let's crunch the numbers. Take a $550,000 home, put down 10%, use a 50-year fixed at 7%. Stay for 12 years, a typical tenure in the U.S., and you've shaved off only $32,000 of principal. The rest, that's money down the lender's drain. Why is this so risky? If the market dips, you could have negative equity. If prices stagnate, you walk away with almost no gain. If prices go up, sure, you benefit, but you would have built more equity on a traditional mortgage. A 50-year mortgage keeps you a renter in disguise. One job loss or one recession, and you're stuck, possibly underwater on a house you thought you owned. Why lenders are chilly about the 50-year loan? Strange as it sounds, banks are not enthusiastic about mega-long loans. Here's why. If rates drop, as they did in late 2024, thanks to Fed easing, consumers quickly refinance, cutting lender profits. If rates rise, as seen in 2025's spring spike, lenders are stuck holding loans at low yields until the 2070s. Banks lose flexibility and take on risk with no real upside. And then there's the regulatory problem. U.S. law bans qualified mortgages, those that meet federal standards, from exceeding 30 years. That means any new 50-year mortgage would be non-qualified, carrying higher rates, less protection for buyers, and more risk for lenders. Current housing affordability crisis in 2025? To put things into perspective, America's affordability crisis hit new highs in 2025. Home prices, adjusted for inflation, are up 44% since 2020. Nationwide, the monthly payment required for a median-priced home now exceeds $2,200 for a 30-year fixed, pricing out millions, especially first-time buyers. Inventory is at historic lows, making bidding wars standard, even in formerly affordable metros like Phoenix, Tampa, and Charlotte. Young buyers are squeezing into smaller, older homes, moving farther from city core, or piling into multi-generational living to afford a down payment. So, politicians are desperate for ways to fix housing, and the 50-year mortgage is their latest idea for making monthly payments more affordable. But here's what independent experts are actually proposing this year. 3 real solutions for housing affordability. If extending loans to infinity isn't the answer, what is? Analysts and policy experts in 2025 recommend 3 big changes, each with broad political support. Raise the capital gains exclusion. Right now, married couples can shield $500,000 of profit on a home sale from taxes. Raising that to $1 million, a bill currently circulating in Congress, would encourage long-term owners to sell, freeing up inventory and cooling demand. Make mortgages portable. In countries like the UK and Australia, homeowners can take a low-rate mortgage with them when they move. This reduces the golden handcuff effect and increases turnover, which would help unclog the stock U.S. market. Over 60% of Americans report they're trapped by low rates and high prices in 2025. Portable mortgages could change that. Expand mortgage interest deductions for new buyers. Policies floated for 2026 would boost first-time buyer credits, drop monthly payments by hundreds, and make homeownership accessible without stretching debt to 50 years. None requires you to sign up for generational debt, risk negative equity, or hope for magical market gains.
what do buyers actually want in 2025? Recent surveys show that 78% of Americans want policies that reduce upfront costs, like down payment assistance or tax credits. Younger buyers, ages 24 to 39, overwhelmingly say they'd rather wait for affordable homes than lock themselves into lifetime debt. Meanwhile, home builders are pivoting. Despite headlines, most new construction in 2025 is focused on smaller starter homes, townhouses, and multifamily properties, hoping to appeal to buyers priced out of the single-family market. So don't expect the 50-year mortgage fad to last if buyers keep demanding actual affordability.
The economic ripple effect. Longer dead timelines don't just hurt homeowners, they can destabilize local markets and communities. Owners with low equity are less likely to move, keeping inventory low. Negative equity can cascade into foreclosures, as seen in pockets of Texas and Nevada this year when post-pandemic buyers faced unexpected job losses. Banks attempted pilot programs for ultra-long loans in early 2025, but so far they've found higher default rates and lower buyer satisfaction. The verdict. Bottom line, the 50-year mortgage isn't a solution, it's a trap. It won't fix affordability, build equity, protect buyers, or strengthen banks. It's the ultimate kick-the-can policy, designed to make politicians look like they're helping while saddling a generation with debt that outlasts even their longest Netflix subscriptions. The average American homebuyer in 2025 is age 40. With a 50-year mortgage, they'd finish paying it off at 90, or more likely, leave the burden to their heirs. That's not the American dream. That's a lifetime subscription to financial anxiety. So, if you found this breakdown valuable, hit like you're refinancing a terrible loan, and subscribe to Housing IQ for more no-nonsense real estate truths. Because if there's anything the housing market has in 2025, it's drama, and you deserve the inside scoop without the distractions.